Good morning, ladies and gentlemen. Welcome to the Horizonte Minerals PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions that are submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And then I would like to hand you over to CEO Jeremy Martin. Good morning, sir.
Good morning. Good to be with you again. So for a number of you, obviously you're aware of the story, but for those of you that are new to the Horizonte story, this provides an overview of our business. We're listed on the AIM and the TSX in Canada. We're focused in Brazil, and our business model is to build out a scalable, low-cost, next-generation nickel producer. We have 100% ownership of two Tier 1 assets, the Araguaia Ferronickel project, which is currently under construction, moving towards production of first metal in Q1 24, and the Vermelho Nickel-Cobalt project, which we acquired from Vale, is moving through feasibility study with a construction decision in the next 24 months. Between these two deposits, we've got over 3 million tons of nickel resource base, and that allows us to build out annual production of around 60,000 tons of nickel a year, which will be a very significant nickel business. We aim to be one of the lowest CO2 per ton nickel producers in the world. We've got a very strong team, not only for the construction, but operation. And we've also got potential to expand this nickel district beyond that production footprint. This is our business model and our key goals. If you look at phase one, that is about the asset base that we have today. We've talked about Araguaia. It's designed to produce 29,000 tons of nickel a year through line 1 and line 2. And it's got a long mine life, over 30 years. And then the Vermelho project, it had a feasibility study completed by Vale. We resized the operation to a smaller footprint, and that will produce around 24,000 tons of nickel and over 1,200 tons of cobalt. And that is going through the feasibility study, and that will have a plus 30-year mine life as well. We closed out a financing package to build Araguaia late last year in December, $633 million. And we also closed a royalty financing package of $25 million for Vermelho to allow that to go to feasibility study. We're currently executing on that business plan. Araguaia was approved for construction in January. We're well advanced on construction, as you'll see in this presentation. To date, we've awarded over $370 million of packages and services, and the feasibility study on Vermelho is moving through to award of contracts, and you'll start to see news flow from that later this year. And then our growth platform is, once we have Araguaia line 1 in production in 24, we aim to then start moving on line 2 to double capacity. We aim to have Vermelho at the point of being able to make a construction decision within 24 months. And we also have a large land position where we see the potential to increase our resource base through discovery. So that's our business model and goals. This slide here shows that build out of annual production over time. On the left-hand side, you've got Araguaia line 1, which is already under construction, will produce around 14,500 tons of nickel. Line 2 will double that, taking us up to around 29,000 tons of annual nickel capacity. And then if you look at the Vermelho nickel equivalent, which is the cobalt and nickel production, that's over 35,000 tons of nickel equivalent, taking us to plus 60,000 tons of annual nickel production. And you can see on the right-hand side, that would put us in line with what Anglo American produces today. So this is a very sizable production profile. Looking at the nickel market, there are a number of key drivers which make this a very exciting space to be active in. Obviously, we've heard a lot about nickel in electric vehicle batteries. That growth profile is showing exponential uplift over the next 10 to 15 years. But I think what hasn't really been recognized is the use of stainless steel, which is the main use of nickel today, in all those other energy sources as we move to net zero, whether it's geothermal, whether it's nuclear, hydro, wind turbines, or carbon capture. Anything that has a corrosive high temperature environment has stainless steel in those power sources. So that's going to be a major demand driver going forwards. And if we look at the next slide, which shows the sort of supply-demand balance running out to 2040, you can see there the demand picture shown in the dark blue line. And obviously you've got existing supply in the light blue at the bottom of the graph. And what it's showing is where we are today, stainless steel accounts for over 70% of nickel demand, with batteries accounting for around 12%. By the time you move out to 2040, that battery demand has increased to over 40%. Stainless steel is growing at about 5% a year. And you can see there that they're both accounting for sort of a 50-50 split in the market. But what that means in terms of new supply is phenomenal. We need 2.4 million tons of new nickel to come online by 2040. And this year we're going to produce around 3.2 million tons of nickel. And I think there are some fundamental drivers that make nickel a very exciting space. We've had 10 years of underdevelopment in the sector, which means that next generation of projects in the pipeline of construction-ready projects is just not out there. You've got the two very strong demand drivers we've talked about, stainless steel showing continued growth through those energy sources and also just existing construction uses, and then the whole EV battery sector, which we know is growing at phenomenal rates in terms of rollout of global EVs as we move to net zero. And that is why Horizonte is so well positioned with two tier one assets, one in construction and the other moving through to feasibility study. If we look at our sustainability drivers, this is a key part of our business model. We want to be producing a future source of nickel that is a leader across all of the ESG pillars. From an environmental point of view at Araguaia, we will be recycling over 90% of our water. We produce no tailings. We produce a granular silica slag, which has downstream uses in asphalt construction material. And we will be one of the lowest CO2 producers in the ferronickel space. From a community point of view, Araguaia is going to be the largest employer in our local town, Conceição do Araguaia. We will generate over $700 million of taxes and direct employment over the 30-year mine life. And as a result of that, we've got very good government, local community support for the build out of Araguaia. And you can see there some of our stats. We are really targeting our employment rates in and around the project. We've got training programs underway currently to ensure that we have future workforce for the operation. And we see this as a multi-generational economic and social driver for this part of Southern Pará. Moving on to Araguaia itself. So for those of you that are new to the company, this shows the 3D layout of the Araguaia plant. It's designed to be built in two stages. Stage one is what you see there on the slide, which is already under construction. Stage two will sit effectively alongside line one, and that will double capacity and take us up to 29,000 tons of nickel a year. We're producing a high-grade product called Fe 30. That means it grades 30% nickel, and the balance is refined iron, and that is sold directly to the stainless steel manufacturers. We are looking at a nickel matte circuit in line two, which would mean that we're able to supply battery grade or battery upgrading material from line two. It's shallow. The maximum pit mining depth is around 25 meters. And we're using a 60-year-old technology called rotary kiln electric furnace. So the technological risk on this flow sheet is low. If we look at the economics at the sort of average nickel price over the last 3 to 4 months, which is around $23,000 a ton, on line one, you can see payback is less than 2 years. The IRR is 40%. Crucially, we will be in the lower part of the lower quartile with a cash cost of sub $7,000 a ton. And it's worth noting that Indonesia is currently the sort of reference point for ferronickel, and their costs within Indonesia in the last 24 months are now looking somewhere towards $14,000 a tonne. So that gives you a feel of how competitive Araguaia will be, and it will generate an NPV of $1.5 billion. And then when we bring line 2 on, you can see there that NPV goes up to $2.4 billion. Our C1 cash cost still remains in the lower quartile, and the upfront capex is estimated at around $250 million. So this will be one of the lowest ferronickel operations globally, one of the lowest cost globally. And you can see there, just flexing for nickel price, our base case models that were run for the debt financing were run at $14,000 a tonne, but it shows this is a robust asset all the way down the cost curve. So looking at looking at progress on site today, we approved the project in late January. We mobilised the site in May. So a huge amount has been achieved in the 4 to 5 months since we approved the project. You can see there, crucially, no lost time injuries, over 375,000 hours worked. The project has just been approved as a strategic minerals project by the Brazilian federal government. And these show a snapshot of progress on site that's been achieved over the last 4 months. And I will talk through more detail on these over the next few slides. And as we sit at the end of September, we're around 16% overall project completion. So, as I said, earthworks commenced when we broke ground in May. We're about 70% complete on earthworks. Top left area, you can see the admin, and you can see the main plant site. On the top right photo, this was taken 10 days ago. This is the main furnace foundation pad, which is being poured as we speak. You can see in the background there the large piling deep pile foundation rig, which has drilled over 50 holes to date across the furnace pad, and it's now preparing the rotary kiln foundation pads. The civils contract was awarded in mid-June to Copper, who also undertook the earthworks, and they are advancing the concrete pours across all of the key foundations on site. This shows top left-hand corner the primary crusher pad, and you can see in the front of the photo there the reinforced concrete retaining wall, which is being built out. And the primary crusher will sit on top of that, the material being tracked up onto that pad from the pit, and then it feeds into the primary crusher and then is taken across to the homogenization shed. So you can see precast concrete panels being erected and then built into that reinforcing wall. Then we move into some of the equipment packages. This top left-hand photo shows the furnace shell, hatch furnace, that was trial assembled in South Africa. The base plate was actually delivered to site 10 days ago, and you can see there the heavy lift crane unloading those base plate sections ready to go on that foundation. And also parts of the rotary kiln are well advanced. Other packages that have been awarded are the main 230 kVA power line with that's got 3 work fronts currently underway with pylons being assembled. The water cooling dam is being advanced, and all of the other on-site infrastructure packages are well advanced. Another transaction that we completed late last year was the acquisition of a rotary kiln electric furnace project in southern Brazil, RKEF plant. This plant was about 60% installed before the company that owned it put the project on permanent care and maintenance due to the collapse in nickel prices. What's interesting about this plant, this was actually the plant that we originally designed the flow sheet for Araguaia around. So all of the equipment is brand new. Much of it is still in its original factory protective wrapping. We will be using certain components for line 1. But where this really comes into its own is allowing us to fast track and lower the cost of line 2. There's a brand new rotary kiln there that will be installed for that line 2. There was about $200 million of spend on this plant, and we actually acquired it for $7 million. So it's been a very beneficial addition to our company strategy. I want to touch on the team. We've built out over the last 8 months an extremely strong construction team with leaders across the ferronickel arena, and also we've inbuilt a number of key operational people into that team. So Mike Drake, our head of projects, he joined us 18 months ago, having been involved heavily with BHP in their Cerro Matoso operation in Colombia and also Nickel West. Likes of Leo Viana, our project director, again involved in Vale's ferronickel project in Indonesia. And then on the operational side, Marcia Weisen, for example, is head of commissioning. She's been involved in commissioning over 12 furnaces in her career for the likes of Hatch, CMAG, extremely knowledgeable in terms of the ramp up of these furnaces. So we've got a very strong team with the ability to take this through construction, through ramp up and operation, and then also move across to line 2. This shows our project schedule. This schedule has been the same from when we approved the project in January. You can see all the key milestones that we've completed in Q1, Q2, and Q3 this year. And the key driver here is that the first metal date in early 2024 remains unchanged. So we've been able to ensure the project remains on schedule. We have just announced, obviously, a fundraise where we've just raised $80 million. The key requirement for that was we're moving towards the first tranche of debt, and you have to undertake a cost to complete test. We have obviously seen an inflationary environment in Brazil that wasn't there when we approved the project and completed the updated capital costs mid last year. We've seen inflation in Brazil hit 12.5%, and we've also seen input costs go up significantly. For example, concrete has gone up 300% during the last 6 to 8 months in Brazil. So it's not just that headline inflation, it's also a function of post-COVID stimulus driving a huge amount of activity in the construction sector in Brazil, which means that contractors have been building in margin. We've seen diesel costs go up, and as I say, things like concrete and steel costs go up. So as part of that cost to complete test, this is a long build. It's 24 months build and 12 months ramp up. We needed to close out a funding gap, and that allows us then to move through to first draw on the debt with those lenders. We got very strong support from a raft of our existing shareholders, in particular La Mancha, who will see their position increase from around 19% to sort of 24.5%, and Glencore moving from just under 10% to around 17.5%. And I think that's a very strong endorsement, having somebody like Glencore, who is a leading global nickel producer, increase their participation in what we're doing. I think is a very strong endorsement to the market. So we're now financed to see this all the way through to first metal, and that should ensure that if we have any challenges in the market over the next 12 to 24 months, that we have sufficient buffer within our capital allocation to see us through any periods that may come at us. Moving on to our next project, which is the Vermelho Nickel-Cobalt project. This is a very large, scalable nickel-cobalt resource. It's one of the highest grade undeveloped nickel-cobalt projects in the world. Vale had spent around $300 million on this. They gave the construction go-ahead in 2005 to build a $1.25 billion HPAL plant. The only reason that this project wasn't built at the same time, they bid $17 billion on Inco, which was Canada's largest mining company at the time. They acquired that. And within that portfolio, there was a basic carbon copy project called Goro in New Caledonia. That was under construction. You don't build two of these at once. So Vale completed the build of that, and Vermelho was never built. We were able to acquire it at the bottom of the nickel market. We paid $8 million for it. Why it was attractive to us was initially as potentially a high-grade feed source to Araguaia. But as the whole EV battery market has evolved, we now see this as a standalone operation. We see from our pre-feasibility study the ability to produce over 24,000 tons of nickel a year and 1,200 tons of cobalt. And this will be battery grade or to feed into the battery market. It's one of the, as I say, highest grade undeveloped projects out there. The feed to the autoclave over the first 10 years will be around 1.8% nickel. And this has a long mine life. And you can see from our PFS economics, again, at the same nickel price that we use for Araguaia, it's an altogether larger project than Araguaia, but the economics are compelling. Again, low C1 cash cost. Over the plus 30-year mine life, it generates over $12.5 billion of free cash flow, an NPV of 3.4 billion. And again, you can see there high grade over the first sort of 10 years of mine life and for the balance of mine life. So it's a very exciting project. Showing the flex there for nickel prices going forwards and an IRR, and you can again see whichever range you want to use for your long-term nickel pricing. So we are currently advancing Vermelho through to feasibility study with that standalone financing package, and you will see news on Vermelho as we move through the next 12 to 24 months. And really to conclude today, the Horizonte story, we have a very high quality portfolio, which we own 100% of. Araguaia is fully funded for line 1 to produce first nickel in Q1 24. We're able to supply both sides of the nickel market. Araguaia producing that high grade Feni to go into the stainless steel market, and then Vermelho to produce intermediates or final battery grade product for the battery market. Between the two assets, we're able to build out over time that 60,000 tons a year of annual nickel production. And there are very few portfolios globally that allow you to do that outside of Indonesia. We're funded. Our ESG credentials in terms of our CO2 per ton of nickel will be some of the lowest out there in the marketplace. We're in a mining region. We're south of the main Carajás district, which means we've got hydroelectric power, roads, rail, all which lower the cost of development of these projects. And I think the other thing we're seeing now is there's a significant scarcity across the market of quality assets like this, and we're starting to see the tier 1 majors move into acquisition mode, and we believe we are very well positioned to play into that market, and obviously we'll look at that as our business model evolves. And that brings us to the end of the presentation, and I'd like to open up for any questions.
Jeremy, Simon, that's great, and thank you very much indeed for your presentation this morning. If I may, I will just bring back up your camera. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Jeremy, Simon, we did receive a number of pre-submitted questions ahead of today's event, as well as you can see in the Q&A tab, a number of questions that have been submitted throughout today's presentation itself. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Simon, Jeremy, if I could just hand back to you to respond to those questions where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Yeah, absolutely. Thanks, Jake. We've got a fair number of questions that have come in, so we'll do our best to get through these. So the first question I can see is focusing on the second line at Araguaia, what would the timeline be? So obviously our core focus at the moment is getting line 1 ramped up and through that ramp up period. There are certain restrictions around development in line 2 linked to that financing package, so we do have to complete line 1 as you would expect. But we are advancing work on line 2. That will be in the form of an updated AAC Class 3 cost estimate, moving through basic engineering, and we're also going to undertake site preparation, etc., while we've got the various contractors on site. And obviously you've got to remember we've also got that new uninstalled rotary kiln from the Votorantim package that we acquired last year. But in terms of timeline, obviously complete line 1. We will then look at a funding decision for line 2. I think the second and third questions I'll actually combine. It said, so the question is the money that's recently been raised sufficient to take you all the way through to first production? And another question that links into that is, why did you raise the money now? So the first point here is, yes, financing combined with the initial project finance is sufficient to take this line one all the way through to first commercial production. That's obviously with the caveat that we don't have any significant untoward events that we can't plan for. For example, if the wet season runs for an additional 3 months, which it hasn't historically done, but these kind of things are outside of our control and obviously will have a knock-on effect. Why did we raise the financing now? Well, good question. I think it's worth just walking through, and I did cover it in my presentation earlier, but the way that traditional project finances are structured, such as ours, is you have to spend the equity and you have to show completion of that equity spend to the lenders before you can draw down the first tranche of debt. Our target for that receipt of first tranche of debt is in November. And what has to happen, you have to run through a cost to complete test. So the lenders look at the whole project financing package. They look forwards through to completion and first metal and ensure that obviously there is sufficient financing within the package to complete that cost to complete. And what you have to remember here is we've got a 24-month build and a 12-month ramp up. So we've got 2+ years ahead of us to look forwards. We've talked about those inflationary pressures that we've seen in the last 6 months in Brazil. And unfortunately, that did result in obviously this funding shortfall. And the reason we had to close that now is to ensure that we receive that debt in November. And you've obviously got to allow for the 25-day general meeting. So that was why this window was so important for us to close that fundraise, and we were successful in doing that. So hopefully that answers that question. I think the next question I'm going to let Simon answer.
Yeah, so the next question is, why did you take on more cash than you were initially looking to raise? So the initial target was $70 million US, and that's a result of the cost to complete exercise that Jeremy has just talked through. We received significant support from both new and existing shareholders. And in light of that, and the fact that there is a lot of risk in the world, macro factors are very volatile at the moment, very challenging to say the least with inflation. We thought it was prudent for us to increase the raise ever so slightly to give ourselves additional buffer going into the most important part of line one construction leading into the ramp up. The next question is kind of related. When the last raise was announced, alongside the financing, there was 100 million of contingency. Why does the company need to raise again, especially given the US dollar strength? It's worth noting that following this cost to complete exercise, we will retain approximately $60 million of contingency and buffer leading into this process. So the majority of that still remains intact. So from a percentage point of view, we're in a more conservative position than we were at the beginning of the construction. So as Jeremy's mentioned, and I'm sure everyone is aware, there's a lot of inflation throughout the globe. We're seeing it in double digits pretty much everywhere. We have a 24-month build, as has already been mentioned, plus a 12-month ramp up, which means that, that there's a lot of additional inflation creeping into these contracts that we were not expecting at the beginning of the process. Adding to that, you've also got additional impacts on interest rate curves rising, which obviously there is a debt facility that we will be drawing on in the not too distant future, and then there's a long period before we start repaying that. And the capital costs now have gone from 537 million up to 537 from 477. So all of that combined and the cost to complete exercise meant there was a requirement to plug that shortfall.
And I think just to add to that, I mean, look, we've obviously worked extremely hard as a team to manage that cost pressures. And I think seeing a cost increase of 12.5% versus our original budget, obviously something that we're not pleased about. But in the overall global scheme of project development and sort of project overruns that we're seeing, we think it's a manageable outcome based upon seeing highs of over 12% in Brazil in the last 6 months.
The next question I will take as well. So we've had this a few times actually, I can see it coming in. So could you comment on shareholder alignment and the fact there was no retail offering? So look, we looked long and hard at this and we explored every single opportunity, and unfortunately the regulations meant that we were unable to do a retail offering. This was done by way of an accelerated book build after the market closed. And there was very little scope to do anything from a retail point of view with looking to close that overnight without doing a full prospectus. A full prospectus would have taken us a significant amount of time, and due to the timing pressures with the banks and the cost to complete exercise and the equity spend and the drawdown profile of the debt, this had to be done in a very short space of time. So unfortunately, we could not even open up a primary bid. And the reason for that is because we did a retail offering up to the full allowable amount as part of the prior raise. And that's a one-shot amount that you're allowed to do in any 12-month period. And because we fall within the same 12-month period, we were not allowed to go direct to retail shareholders. So we are cognizant of that, and we really wanted to, we kept the discount to what we think is a sensible and very low number when you look at comparative raises that have been done globally. Some of them have been done at significant discounts, 20, 30, 40%. Ours was done at a 9% discount, so hopefully retail shareholders were not too disadvantaged and they could actually buy very close to the placing price over the last few days and since we've announced the deal.
But just to add to that, look, there's been a lot of commentary post the raise about management's perhaps disregard for retail shareholders, and that's absolutely not the case. We see retail shareholders as a key part of what we're building here. A lot of you have been shareholders for a long period of time, and we're absolutely going to ensure that we work and cater for the retail market the best we can going forwards. So I think the next question up, I'll take, it's what is the timeline for completing and publishing the Vermelho feasibility study? So as we announced and we talked about earlier, there is a standalone $25 million financing package for Vermelho. Vermelho really is what we see as the sort of next big value driver in our story. We want to be able to take the project from pre-feasibility to feasibility study and really demonstrate those economics that we've already shown in the PFS. Work streams are already underway on the feasibility study. It will be a 24-month process. We hope to complete before that, but that's the current timeline. And also that will advance the permitting to the preliminary license, which is the key license in the kind of process in Brazil. And that means that at that point, we will be able to make a construction decision subject to financing. So that's the timeline on Vermelho. Next question we've got around sort of Brazilian regulatory administration. Obviously, it's obviously linked to the upcoming elections. And it said, are there likely to be any changes in tax policy, and how would Horizonte's projects economics be affected by this, and can they absorb the changes? So look, this is a slightly difficult one to answer because the detail from both candidates around policy has been very light to date. So trying to make any informed decisions is sort of guesswork at this stage. Look, what we do know is I think we've had obviously 4 years of the incumbent government, which has been pro-business, pro-mining. So I think if the incumbent is to win, it'll be business as usual. And then if the PT party win, again, we've had 10 years of PT prior to the current government. We've operated through that. There were some minor moves around on sort of royalties, etc., which were watered down. And we don't see any significant changes. We're governed under the para state. And I think from what we have alongside that strategic project award, we see it being business as usual. Next question, I think for you, Simon.
Yes, so this one says, at the last October presentation, we were told that nearly $375 million worth of contracts were already awarded. do these contracts have cost guarantees? In the event of a cost overrun, will the company be liable to source additional capital? Additionally, how much cost visibility does the company have over the remaining capital expenditure? So yeah, $375 million worth of contracts have already been awarded. That was heavily weighted towards the front of the year, where we locked in a lot of the overseas equipment packages, and they were predominantly denominated in US dollars and or other currencies rather than local real. These are predominantly fixed cost contracts. There's some very slight variability for some of the input prices, such as copper and steel, but it's very insignificant in the grand scheme of what we're doing. So those are all locked in. What we are seeing is inflation running in the local contracts. So that's the labour, the concretes, the locally sourced steel, the service contracts, because they're all obviously linked to CPI or RPI within Brazil. And they are subject to much higher levels of inflation because the equipment purchases were predominantly locked in pricing for Q4 21 that we had up to 6 months validity on. So we've done very well on locking in $375 million worth of contracts to date. In the event there is a cost overrun, will the company be liable to source additional capital? So we have approximately $60 million of buffer, which is comprised of contingency, growth allowance, as well as a cost overrun facility. So the cost overrun facility can be drawn in the event that we go over and above any contingency that we are carrying. So contingency is used first, then the cost overrun facility subsequent to that. There are ongoing requirements to satisfy the senior lenders that we have enough capital to complete the project. In the event that the lenders are not satisfied, there may be a requirement for additional capital. But we are pretty confident. We've been out in the market at the absolute peak, so we're fairly confident in what we're seeing at the moment in terms of real-term pricing, and we think we've been prudent enough to weather most reasonable scenarios. Obviously, you can't give any cast iron guarantees in life, especially with how volatile the world is, Ukraine and or other factors that we've yet to see. So that's the contingency that we have available. Additionally, how much cost visibility does the company have on the remaining capex? We have quite a high degree of visibility. So we've awarded a big chunk of the contracts. The balance, $150 million. We are out getting live pricing. We've actually got tenders out for a big chunk of them. We've seen the the initial replies come back in. We've benchmarked these to other operators out there. So we're fairly confident in what we're seeing at the moment, lines up with our revised budget. So the cost overrun and contingency that we're carrying is for unforeseen areas and for execution delays and or issues that we might encounter, rather than any budgetary pressure, because that should all be baked into our revised cost estimate.
Okay, next question. In the project update, you know the Araguaia Line 1 engineering is already over 70% complete. Which engineering items are still outstanding, and when are you targeting to complete engineering? So by the end of November, we will be 90% complete on engineering, and it's really currently focused around piping, electrical, mechanical. We're well advanced, obviously, on all the civil design because that's happening live as we speak. And obviously, there's also additional engineering detail that gets provided as we close out each of the engineering packages on the main equipment as we kind of move through the basic and detailed engineering. So I think by the end of November, 90% complete. And obviously, as we move through to the end of the year, then the engineering is complete. Next question is it your aim to complete both the Araguaia site drain works and grid hookup planned for October before the upcoming wet season? Do you see any significant hurdles to this target? No, we're absolutely focused as we speak on ensuring that the site is fully weathered for all year operation. So that is completion of roadworks to ensure that our travel time in and out of site from Conceição is 60 minutes, because obviously shift change, productivity, etc., is driven by cycle times in and out of site. A lot of work going on drainage. That's all the key concrete culverts, trap points, etc., around the main plant site to ensure that we can handle and deal with drainage during the wet season, any kind of sediment that builds up there. Yes, we aim to be energised on site by the end of October. All of the power poles are up. Lines have been strung. We're just working on transformer connections, so we'll have standalone power source to site. So I think the plan is in place, and we don't see any key issues around being able to work through the wet season. We do have lower productivity levels modelled in our schedule, as is normal for a wet season. So no untoward issues that we see to date. Next question. H&M also announced the potential addition of a nickel matte converter into the plant flow sheets. If costs allow, is it your intention to build a converter at the same time as line 2 and then incorporate material from both line 1 and line 2? Or will you try to build this out ahead of line 2 completion in order to start incorporating some material from line 1 alone? I think, look, we're at the early stages of the design and how we would integrate a nickel matte converter. It's clearly going to be designed to take a percentage of hot molten ferronickel from the furnace. The idea is that you will potentially be able to tap from either furnace into the converter. The converters are relatively low capex items. They're mainstream technology. Whether we install the converter ahead of the build out of line 2, we'll be looking at that in the engineering study. But the idea is, if we go that route, it will be integrated to be able to draw hot metal from either line 1 or line 2. Next question is, along the full project timeline to plan first nickel in Q1 24, what do you currently consider to be the single largest risk hurdle in hitting this target? So I think a good question. There are obviously some key areas that we're focused in on. One we've just touched on is productivity levels linked through the wet season. We need to ensure we can maintain high productivity levels through the wet season. I think manpower is a key driver to ensure that we get the right levels of right skill on site linked to each of the key contracts. And that's working well to date, but we've got a major push over the next 2 months in terms of increasing manpower on site. Equipment supply, that's something that's very high on our watch list. That is obviously, you take the electric arc furnace or the rotary kiln, the equipment is being sourced from a number of countries across the world. We are still seeing some supply side issues around, obviously, the kind of backlash from COVID. Freight rates and freight routes have improved significantly, but there are still bottlenecks on the supply side. So that's something we need to be watching very carefully. So those 3 areas would be the kind of key focus for us. I think.
Yeah, next one I will take. In how many tranches will the senior debt facility be drawn down? What will the dollar amount of the first tranche of the facility be? So the senior debt facility will be drawn down monthly, starting from the point in time where we have spent sufficient equity to satisfy the banks. So we expect first draw to be this side of Christmas. Monthly draws, and the amount will be drawn down in line with the expenditure profile. So the drawdown amounts will actually be variable. So I can't give you a definitive number on that because it depends on contracting and invoicing.
I'll take the next one here is, will the construction of Vermelho result in yet more dilution, or will it be funded through FCF? I think, look, obviously we have been conscious, despite obviously some of the views on dilution. We've got a full financing package to complete the feasibility study. If we are looking at building Vermelho 100% Horizonte, clearly there is going to be the requirement for a financing package, similarly along the lines of Araguaia. But our view there is we're looking at 2 years down the line, and we would see our value significantly higher by many multiples than we are today. So obviously that will limit the dilution. But equally, There's a raft of deals we're seeing in the market at the moment, from the OEM and battery manufacturer space, where we're seeing some very competitive financing being put into projects, and we have the ability to do a project level transaction. So look, we are focused around the value build there and obviously limiting dilution. I think in terms of time, we're probably heading into our last question here. We've got sort of quite a few repetitions coming through, which I think we've answered already. So the last question I can see is, why not update the Vermelho feasibility study made by Valley instead of redoing one from scratch? Very, very valid question. I think, look, the Valley feasibility study was 2015, so all of the costs in that are completely outdated and not relevant to today's market. We will, however, be using a lot of the historic engineering data, and that will actually allow us to fast track the feasibility study. So the Valley data will very much underpin a lot of the engineering work, and it will be simply updated for technological and operating improvements. Bear in mind, back in 2015, this would have been the sort of first, it would be sort of generation 2 of the H-panel plants. We had sort of cores in Australia, generation 1, and this was designed at the same sort of time as the mega projects, which were all obviously significantly over budget. So there's a lot of history and technological advancements and lessons learned that will be built into this new study. But absolutely, the engineering data will be integrated and updated. Obviously, we're redoing all of the permitting. There will be changes to some of the infrastructure on the site, which require additional engineering, ground geotech, etc. But it very much will form the basis of the study, as did the PFS. So I think that really brings us to the end of the questions, and perhaps back to you, Jake.
Yep, Jeremy, Simon, exactly. Thank you very much indeed for addressing all of those questions that came in from investors this morning. And of course, we will give you back all of the questions that were submitted today for you to review, and then add any additional responses where it's appropriate to do so. Jeremy, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, absolutely. Look, it's been a pleasure to be here this morning. Hopefully, we've been able to answer a raft of the key questions that have been sort of coming in. We are at a very exciting juncture for the business. As you've seen from the photos, construction is advancing at a very significant pace on Araguaia. We're on track for that first metal date of Q1 24. The nickel market is very well positioned for what we're going to be delivering into it. Vermelho is moving forwards, and as I outlined in our presentation, the business today has two of the best assets in the market. They're 100% owned, we're financed, and now it's about really starting to build the value in the business for you as shareholders. So looking forward to keeping you updated, and thank you very much.
Jeremy, that's great. And Simon as well, thank you once again for taking the time to update investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can understand your views and expectations. This may take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Horizonte Minerals PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.